Hey, friends, this is going to be a super simple introduction to options. And I'm going to be doing it from the point of view of somebody who has never actually, maybe they've traded before, and maybe they're familiar with the Thinkorswim platform, but they don't really understand everything about options. But maybe they want to know how to push the buttons to see what's going on. All right. So that's the way I'm going to be taking this. And so might be a little bit different than other options courses that you've participated in. Any event, this is going to be the anatomy of stock options. So, first of all, what is an option? People say that it's a derivative of stocks, right? So, don't let that scare you. Basically, it's just a contract or an agreement to either buy or sell stocks at some future date at a certain price. So, that's fundamentally what it is. It is just a contract between you, someone who's selling it, and you, the buyer, to use that contract um, to fix a price somewhere in the future date. All right. And then you can exercise that contract anytime you want up until that date. So it's a, um, let's say it's a weekly option or even a month. Let's say that it expires in a month and you have something like the SPY. Let's see if we can bring up a chart here of the SPY, and we'll tinker with that. So here we are. Here's the SPY, the S&P spiders. There we go. So this is a 5-minute chart. I don't know. Let's do a daily chart so we can see more stuff. So it goes back almost to the beginning of the year, right to the beginning of the year. There we go. So a daily chart of the SPY. Here we can see the big dip that we took in March because of the pandemic. And now we've been steadily climbing up, each one of these bars representing a day of activity. Now, currently, SPY's price is 322. Suppose that we bought a contract to buy the SPY at $310. All right. And that contract's good for a month. Now, right now, that contract is worth the difference between where the price is now and that price that we agreed upon, $310. So it's $322. So it's worth right out of its face value, $12. So it's the what's called the strike price on an options contract and the current price. That $12 is called the intrinsic value of an option. So it's always the difference between whatever the strike price is and wherever the price is right now, and that's the actual underlying value of the contract. Now, so if I were to exercise that contract right now after I bought it. It would be kind of a loser. It'd be kind of dumb. I'd be losing $12. Now, one thing else that you should know that when you buy one of these contracts, it represents 100 shares. And anytime you see pricing in the market for an option, it's always based on one share. So you have to multiply it by 100. So let's take a look at what that looks like. So what I did is in Thinkorswim, I just went from the charts tab to the analyze tab. And because we're going to take a look at buying a SPY option. You can see in the upper left-hand corner, it says SPY. And I'm going to add a simulated trade, right? And here, what we're looking at here are all the different contracts, the expire, when they expire for SPY options, going all the way out. Well, it goes way out, all the way out to December of 2022. And you can see there are different types of contracts for SPY. You'll see some of them are called weeklies. Those are ones that expire on a weekly basis. The ones that don't say weekly, they expire um, on a monthly basis. All right. And if you look at this list and see that there are little arrows here, and I can click them and drop down and see what's in there. Right. And then in parentheses, you'll see, well, right now you'll see the 15 July 20 weekly. It says 0. That means there's 0 days until it expires. So it's going to expire, or it's already expired. It's already expired, actually. The 17 July is going to expire in 2 days on Friday. And that's the monthly contract. So the monthly July contract expires in 2 days. And then the weekly expires. The next weekly will expire next week in 5 days. So that's what these numbers here mean. That's when they expire. Let's take this monthly contract that expires in 2 days. And to make it simple, I'm not going to show all the different strikes. I'm going to just show some of them. Show 14 strikes. So we can, when we choose this one contract, we can buy this a contract date, when it's going to expire, and at what strike price that we want. So here's a listing of all the different strike prices for that expiration. It's not all of them. It's 14 of them, 7 below and 7 above the current price. And you'll see at 322 seems to be the demarcation point. You'll see that there's a gray area here and then a dark area on the left-hand side of the calls and on the right-hand side of the puts. So we have a dark area and a gray area. The gray area is the area that has intrinsic value. Remember, I said it's the difference between the strike price and the current price. So if that number is positive, then it has intrinsic value. So for instance, right now the price is about 322. Let's say that we bought something a 318. When I said a 310, but let's say a 318. The difference between that is $4. So you'll see if I go over here, the value of it, the ask price is $5.27. That's more than $4. What's going on here, Ernie? Well, there's another bit of value that's added on to the intrinsic value, and that's called the time premium and the volatility premium. It's actually just time premium, but that's a number or a value that as you get closer and closer to the expiration date, that value starts diminishing until you just have the intrinsic value left. And so that's a variable number that's very important. But right now, that if I were to choose that contract, let's say if I'll just buy one of those, I'll buy it. I'm not really buying it, I'm just setting it up. When I clicked on it, down below you'll see a green record showed up telling me the specifications of that contract. So it shows that it's a July 17, right? We know by looking up here it only has 2 days to expire. It has a strike price of 318. That means that I can exercise this. Exercising it means that I can turn it in and buy 100 shares of stock at $318 a share. Of course, I don't know why I would want to do that, because right now it's worth more than that, so I'd be taking an automatic loss. It's a call, which means that it's a bullish type of contract. It means that I have the right to buy the stock. If it were a put, then it would mean I have the right to sell the stock. And then this is the price of that particular contract right now. You can see it's more than $4 because it includes both the intrinsic value plus the premium, which is also called the extrinsic value. Now I can go and I can take a look at what that contract will look like. Now this is what's called a risk graph, and everybody that trades options loves risk graphs. I'm going to expand it a little bit so it's easy to see. Because this tells you everything that you need to know about the contract. Wider. There we go. So with this call option, there's a blue line. That blue line is the value of this option at expiration. And on the left-hand column, the vertical column is the value of it. And on the bottom is the price of the stock, right? So at expiration, you can see that this was a $318 strike, right? So there's $318. If I held this on at until expiration, I would lose $5,000. Let's do it for just one contract so it's a little easier to understand. That's 10 contracts. I would lose $541, which is 100 times the cost of the option. Actually, it actually comes out to 537. It's changing all the time. It's right here. The price $5.35 per option contract per share, and there's 100 shares, so it would be 100 times that. So when I move my cursor over that line, that's the base price. That's the max you can lose on this contract. You can see that it's about $530 now. And that matches the price over here, 530, 531, 529. It's changing all the time. So if I held this on until expiration, and the price went down to $318, that's what it would be worth. But let's say it stayed the same right here. Well, putting my mouse right over $322, right where the current price is, if I bought it right now, it would be worth about $134. Actually, minus 134 because it's under what I bought it for, right? The break even is right here at $323.24. So we would have to move up to $323.24 just for me to break even. So there's a cost involved with buying this option right up front, right? The purple line here, now one can, very easily see where it's going to be at expiration. That blue line at different prices represents the intrinsic value of the option. This purple line represents the extrinsic or premium value of the option. So if I were to sell that right now, I wouldn't take a loss. I wouldn't take this $139 loss. I could sell it for whatever, and maybe minus the commission or whatever, or the cost, fees. And that's because it still has the intrinsic value plus the premium. That's where that purple line is. So if it went down to, say, 318, where that's the max loss, and I sold it today, I wouldn't actually get the max loss right now. If I sold it today, I wouldn't lose 516 or 500 and something dollars. I'd only lose $230 because there's still the time premium left in it, right? So if I bought it today and it went up to, say, 323 today, before the premium started to drop off. Remember, I said premium drops off as you get closer to the expiration. Because we're only 2 days away from that expiration, this premium is going to start moving down until it matches that purple line is going to move down until it matches that cyan line in 2 days. But if I sold it today at, say, $323, right about there, I would make about $86. When I move my mouse over there, you can see there's a price that hovers there. Also in the lower left-hand corner, the price tells me right here, wherever my mouse is over the chart, what the current price is. If it moved all the way up to $324 today, I would make $162. That's where it is. Now, If I go into the future, see down here it says date 7:15. Let's go one day into the future. I don't know if you saw that, but did you see the purple line moved closer to the cyan line? I'll go back one day. That's the premium losing value. That's the stock losing premium value and coming down. Let's go one more day. All right. Now I'm right at the day, well, the day before, the day of expiration. If I go one more day, the actual expiration date isn't Friday, it's actually Saturday. One more day and it's gone, right? So there's the premium is gone because now I'm listing 7/18, which is Saturday. On Friday, there's still a little premium left, very tiny bit amount. On Thursday, there's more. On Wednesday, there's even more. That's today. Yesterday, there was even more, and so on and so on. If I keep on going back in time, you can see how much premium there was a while ago. But as I approach that expiration, you may also see one other thing, this gray area behind here. You'll see it squeezing in as I go further and further out into time. Let's go back in time. That gray area is one standard deviation of movement of the price. So what it's saying is that by expiration, price could move, at least according to the volatility that's in the stock right now, as low as $313 or $314 and as high as $329. As we get closer, you can see that squeezing until we get to today. Now it's saying by expiration, there's a one standard deviation chance, or about a 68% chance, that it could move as low as 317 and as high as 326. Tomorrow it's going to be a little bit small. Well, actually, it can't show me the future. So that's what that is. That's showing you the percent probability that the market is pricing in how much the price of SPY could potentially move, or what's the probability of it moving. One standard deviation translates to about 68%. So there's a 68% chance that it could move here or here, right? And that's important because everything in the option world is based on statistical probability. And that's because these tools are designed to factor in and figure out what that statistical probability is. Because it's nothing more than a whole bunch of people buying this contract, all betting different prices. And then when you combine them all, these probabilities pop up. Right? That's the simplest way you can explain a call option inside the platform. Now, I could buy this call option by right-clicking on this green record and then choosing confirm and send. And then it will give me all the specifications for that option. It tells me what the break even is if I hold it to expiration, and that would be $323. So if it makes it up to $323 at expiration, by expiration, I'll lose no money. Tells me what the max profit is. It's infinite because it could go up forever. Tells me what the max loss is, $517 now. It was a little bit more before, but since we've been talking, the premium has slipped out of this a little bit, and volatility has slipped out a little bit, so that the extrinsic value or the premium has shrunken even in the short time that we've been talking. Remember before when we first started, it was about $5.30. So it's actually lost quite a bit of money in just this short period of time. And the buying power effect in your account, that's how much money will get tied up if you buy this option in your account, $517. Okay. And then I can click send and it will try to execute that order. It puts in a limit order. Doesn't mean it will get executed right away. And maybe in a future video, I'll show you how you can ensure that you get the price that you want, because a few pennies could make a difference. in your scheme of things. All right. So for instance, here I can even show you that. While we have this up, we'll click edit. And that brings up what the current bid and ask is on this. Down here in the lower right hand corner, you'll see it says mid and natural. So right now it's at the higher end. When it gets in the middle here, somewhere in the middle or average, but this is such a tight spread that it'll probably get filled right away. But let's say that spread, well, right now it's 2 cents. You're probably not going to get filled until it goes somewhere between 503 and 505. Probably have to go to 504. Anyways, that's one way to look at these things. We'll delete that order. All right. So that's options from the perspective of a platform. And I'm going to be holding a class on Saturday where we're going to do options from the perspective of a trader and also from, the nuts and bolts of what these contracts are about. And that class is really meant for people who have taken the course that I'm offering, and they are also subscribing to our alert service, where we're going to have alerts for options. But let me tell you something. That alert service isn't about just trading calls and puts. It's going to be about something much more devious. Just trading calls and puts is a very risky game. What we're going to do is I'm going to show people, first of all, the basics of these options and how to tool around in this platform so that they get used to it. But then they're going to learn how to take that extrinsic value and find out how it can be overstated in the market. In other words, options are overpriced. When something's overpriced and you own it, that means that you can sell it for a profit. And that's what I'm going to show people. I'm going to show people how they can consistently take options. And when I say consistent, I mean daily, and be able to extract a little bit of profit out of it. If you're interested in that, go down below, click asymmetricadvisor.com/C bundle. That's the letter C and then the word bundle. And I'll teach you all about options. You'll come into you'll learn about it. You'll learn our strategies. You'll learn all of that. And you'll be set up with an alert service that will show you how to generate as much as 1, 2, 3% a week, every week, without fail. Not guaranteed, but a really, really high probability that you would make that every week. We trade small so that our risks are never really there. So any one trade won't kill you. There you go. That is the very basics of options. This weekend, we'll go into it in more detail. And then I'll start showing people more complex strategies that combine calls and puts and buying calls and selling calls into strategies that are very easy to set up in Thinkorswim, that you can set them up with literally a one click of the mouse. And you put them on, you watch them, then you take them off and you collect the money. All right. So I was going to go through this entire course. And I thought to myself, why bother? There's so much gobbledygook in here. You still need to know this stuff, sort of the basics. And once you get beyond it, understanding this stuff, and then start treating it like a trader, the actual execution of things. It's sort of like driving a car. When you drive a car, sure, you need to know all the different parts of the car, the wheel, the tires, the gas, the brake, the rules of the road and all this other stuff. But then when you want to get from point A to point B, you don't think about all that stuff. You just get in, turn the ignition on, and then go. Follow the rules, get to where you're going, park it, get out, turn off the car, get out. and you've accomplished your mission. So that's where we're at. I'm going to teach people all about the car. Then I'm going to teach them how to drive the car, and we'll go places. See you next video.